Joining me now is someone who knows the effects of bank closures very well, Sheila Bair. She's the former chair of the Federal Deposit Insurance Corporation, the FDIC. She's also the founding director of the Volcker Alliance and the founding chair of the Systemic Risk Council. She's the author of multiple books, including Bull by the Horns, Fighting to Save Main Street from Wall Street and Wall Street from itself. And Sheila, you and I used to talk a lot. I sort of thought it a good thing that we don't talk as much as we used to, because that means banks aren't failing all the time. But this is something that made me think of you. You used to go through this on a very, very regular basis. I'm curious as to what's been going through your mind in the last 24 hours or so.
Yeah, well, this is an old-fashioned bank run, and this bank seemed to have a reasonable plan to stabilize itself, but its depositors panicked, and almost all of its deposits were uninsured. So insured deposits generally do not run. People have confidence in the FDIC. They don't worry about their insured money, but uninsured deposits can run. And most of this was from pretty sophisticated institutional investors, venture capitalists, startups, as you mentioned. So that's what I find so astonishing, that there was this herd mentality by sophisticated individuals to take this money out. You mentioned my books. I also write children's books, and I'm thinking maybe I should write one about banking for venture capitalists, because the behavior suggests that maybe they didn't understand the mechanics of how banks work. You know, it's a classic Jimmy Stewart problem. You come in and take out all the money at once, you're going to force the bank to close anyway, even if it may otherwise be solvent.
And that's exactly what happened yesterday. By midday yesterday, many people were taking their money out of the bank that federal regulators, your successors, had to step in and say, we just have to stop this.
They did.
The bank's going to fail, but everybody's got to just wait. You'll get your insured money, by Monday.
That's right.
What now happens with the rest of it? I would assume that if another bank buys this bank, they can make everybody whole.
Right. So they'll immediately provide access to the insured deposits. Those have been separated in something called a DINB, a Deposit Insurance National Bank. Everything else, the uninsured deposits and all the assets, the investments, the bonds you were referring to earlier, will stay back in the receivership. I assume the FDIC will try to sell that in whole or in part to interested bidders, and that would be the optimal result. You could sell the whole thing. That would ensure more continuous operations of both the deposits as well as the assets to the extent there are loans, et cetera. A new owner can just take care of all that and manage it. If they can't do that, they'll have to liquidate it, which could be more costly. So, it's to be determined. I assume the FDIC is working very, very hard right now, diving into those assets to try to figure out what they're worth. Once they do this, next week they promise that they will pay some dividend to the uninsured depositors. So the uninsured depositors will get some cash next week. We don't know how much that will be yet. It'll depend on the value of those assets and what the FDIC thinks they can recover. But yeah, it's a difficult situation. It was a rushed failure because of this run, and that always makes it harder for the FDIC to try to continue operations so that the people who use the bank continue to have access to its services. So
when we talk about those days in 2008, when you would, feels to me every Friday, probably wasn't that often, maybe it was.
A lot, yes.
4 o'clock, there would be an announcement from you and your group and Treasury that a bank had closed, that bank had been bought, and Monday morning, Washington Mutual opens up as Chase, or whatever the case may have been. Why did that deal not get made? Because Silicon Valley Bank actually wasn't broken. There was something very particular that went wrong here. It wasn't
broken. You're right. Yeah, that's the sad thing about this. I don't know. I can assume we would do that, but we would usually have some weeks of time. We would have a projected failure list, which we kept confidential, but we would have generally several weeks of time to go out, put together a bid list, let bank potential purchasers come in, do due diligence, and then have an orderly, what we call the purchase and assumption when the bank actually failed. When it's rushed like this from a bank run, I mean, the closest comparison we have is IndyMac Bank during the Great Financial Crisis, when there was a bank run. Some public figures made some statements they probably shouldn't have made, and deposits ran out of the bank. We had to close it before we found a buyer. And that turned out to be a very expensive failure. A bank loses franchise value. The longer it stays in receivership, it loses franchise value. So you always want to try to get it sold before it fails if possible. But because of the run, the FDIC just didn't have the chance to do that in this instance.
Should folks in other banks be worried right now?
No, I don't think so. Certainly, if you're insured, you should not worry at all. I mean, the FDIC has a perfect record of protecting insured deposits. If your account balance is below $250,000, for the vast majority of households, that's going to be the case. You're fine. Banks that I think have very large reliance on uninsured deposits, and then the inability to raise cash quickly if there are redemption requests, I think those are the ones that need to be careful. But I don't see a widespread problem at this point. I hope not. I'm always cautious, Allie, when I say that, because
Sure.
as you remember, during the great financial crisis, there were some early statements, subprime is contained, not a problem. Fortunately, I was not one of the people who said that. But when interest rates rise, it creates instability. My friend and dear mentor Paul Volcker was very critical of inflation targeting because the protracted period of accommodative monetary policy would inflate financial assets, inflate the value of stocks and bonds, and then when interest rates have to go up to fight inflation, the value of those assets go down. I mean, I don't know about you, I lost about 20% on my 401k last year.
Right.
So there's this correction mechanism that can have instability ramifications for the financial system. So I think and hope the regulators on top of it. There's a lot more capital now in the banking system, but I'm still a little worried. I think we need to learn more.
Well, I know you write kids' books. I think that's one over your shoulder. If you do write a book on how the banking system works,
thank you for mentioning this.
that would be fantastic. Great to see you again, Sheila. Thank you for being with us. Thanks for giving us a little reassurance. Sheila Bair is the former director of the FDIC. She's the author of multiple books, including Money Tales, which is a children's book series that helps kids learn about early lessons about finance. And apparently a few of the rest of us need to learn those early lessons about finance as well.